The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A quiet day on Wall Street starts to perk up as trade talk optimism puts a floor under prices. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. Sleepy day, I gotta say. However, we did get some positive trade headlines in just the last few minutes where Howard Lutnick, the Commerce Secretary, says that they're going to try and finish China talks and they could go into tomorrow if need be. Lutnick talking to reporters. You're seeing the movement there. You have S&P around the highs of the session. It does feel, though, Romaine, that we're a stone's throw away from those record highs for the NASDAQ as well as for the S&P. And the good news is you had that bond auction, that 3-year, going off without a hitch.
Yeah, kind of interesting to see the price action, particularly on the equity side here, because we are still sitting on fractional gains, back-to-back gains, but fractional gains to be sure. In fact, this will be the 9th day in the past 10 session where the moves have just been a fraction of a percentage point up or down. But that optimism coming in right now because of progress on the U.S.-China trade talks, that is putting a floor under prices. And the big question now is sort of what breaks us out to that next sort of leg of this rally. The economic data so far has been supportive. We can definitely say that. This morning, the NFIB said small business sentiment rose for the first time this year as tariff fears abated. And you had a trio of Treasury auctions that kicked off today with little to no drama. However, in that same NFIB survey, a net 31% of business owners said that they do plan to raise prices over the next 3 months, and Citigroup is hoarding hundreds of millions of dollars more than it did last quarter to account for potential loan and credit card losses. Now, the next big test for this market is probably going to come from that Consumer Price Index report, which is due in less than 24 hours, and it is projected to show underlying inflation picked up last month. But Morgan Stanley rate strategists, they're calling the report very crucial in understanding the initial effects of the tariffs, but advise traders to be prepared for the one-off chance of a downside CPI surprise, particularly with oil prices subdued.
Right. So you would think that there'd be more volatility within the market. In the short term, not a chance. So the blue line is the VIX contract. We know it's below 18. Now, the white line is the VIX future contract 6 months out. And so you can see the divergence between the two in just the last, say, 2 months. You have higher volatility probability in the next 6 months than you do right now. Now, my question is, if that doesn't come to fruition and over the next 6 months volatility comes down, do we re-rate again with the equity market, or are we in for another shock event that now we're not positioned for in the market, Romaine?
As we kick you off to the close, Julie Biel joins us, Chief Market Strategist at Kanye Anderson Rudnick. And Julie, I'll pick up where Alex left off. And I am curious about kind of what sort of facilitates the next leg of, well, anything.
Yeah, I think we're sort of coming out of this period where the news flow was so fast and so heavy. It's a little bit like when you're a new parent, right? And you get no sleep, and then suddenly you start getting like 3 and 4 hours, and you're like, wow, this is so nice. It's been a little bit like that where we're just not used to not having tons and tons of news flow to drive the market. We're sort of just back to boring old fundamentals. And I think that's a good thing. I think that it allows people to digest what happened during earnings and to think more clearly about any kind of downside risk they have vis-a-vis tariffs, because we still don't really have agreements, right? We have the ideas of agreements, concepts of agreements. And so I'm hopeful that we get more clarity, but we still have a lot of uncertainty, and I think we've gotten maybe a little bit complacent about it.
Absolutely. And the great thing, Julie, is once you get teenagers, then you just hide out in the bedroom trying to avoid them for half the day. I am curious, though, in all seriousness, we talk about these headlines moving across the wire right now about progress on those China trade talks. There's been a lot of talk as to what really drove this rebound rally off of those April lows, whether it was truly about trade or whether it was more about broader economic conditions, including those conditions that might be somewhat divorced from the trade story.
Yeah, I think it's a mix, right? I think part of it is this recognition and realization that, you know, there may be more bark to bite with this administration. And so that gives people a lot of comfort that there may be a lot of rhetoric, but we're going to pull back from the brink. Nothing's going to get so crazy chaotic. We still don't know that, honestly. And I do think that in general, you know, first quarter earnings were pretty good and the hard data still looks pretty okay. I think it's going to look messy because we don't know how much was pulled forward in anticipation of tariffs. But I think broadly speaking, things look okay, certainly better than you would have guessed reading a lot of the headlines in April. And I think that that is what's causing investors to be a little bit uncertain, but generally a little bit more positively positioned.
And that's what I'm trying to understand. Do we need less bad news for the market to grind higher, or do we actually need good news at this point? And what does that good news actually entail? If you want to stay away from that scenario, where's a good place to hide?
Well, I think the thing is that now we're in a place where the good news has to be probably a little bit more fundamentally driven, right? Because valuations are now back and looking a little bit on the rich side. And so in order to kind of push forward from here, we do need earnings growth to look pretty solid and to look pretty durable. So I think that broadly speaking, the setup for, second quarter earnings is pretty important and pretty critical. We may see companies more willing to put forward guidance so that you can kind of anchor on something a little bit more reliable. But I do think that you still have this kind of underlying concern that things can turn really, really quickly. And my broader concern is that if I think about this fight that's happened this weekend between Trump and his number one ally, Elon Musk, is that really someone I want to negotiate with if I'm a large country? It's a little bit concerning, right? If agreements are going to slide and move around, it's hard. So I worry that that's a little bit not in this market,
right.
And that's something people need to be thoughtful about.
What's also so confusing is the good news priced in? And I just used the moment price action from just the last 15 minutes, is that you have Howard Lutnick, the Commerce Secretary, telling reporters that he's going to try and finish the China trade talks. They could go into tomorrow if need be. He's saying he hopes they end this evening, but they could continue, and the market jumps.
Yeah, I mean, I think it's a real question of what were people's expectations from these talks. And I think the thing is I don't think people were looking for anything very specific, maybe something on precious materials. But I think what mostly people were looking for was what is the tone? And I think that the tone sounds pretty grown up, and that's causing people to feel pretty good. Okay, we're going to have rational heads at the table. Everyone is going to be acting from a thoughtful economic place, and that is going to enable us to move forward with a better relationship with China. I still think that the positioning with China is weaker than we are playing it out to be, right? If we think about where China was in terms of tariffs even before last year, the first time we did tariffs with the Trump administration, we were, I think, 19% of China's trade, and now we're down to 12. So I worry that we overplay this hand a little bit too much, because I think we have to recognize that we are the biggest game in town, but we're not the only game in town.
So what is it like an investable opportunity right now, though, Julie? I mean, I know there's been a lot of talk about the thematic trades, whether it's around AI and some of those types of things. I mean, what do you find attractive, given all that we've just said over the last few minutes?
I think the thing that I'm kind of interested in is, underneath all of this has been this morass in the capital markets where there just really haven't been a lot of transactions. And I think what I'm getting excited about is I'm getting invited to sit on more testing the waters meetings where we meet with companies before they're going to do their IPOs. We do like a nice gentle conversation with them so that they can kind of learn what it's like to talk to an awful PM like me. And that makes me excited, right? Because I think that's really been something that's been lacking from this market. It's something that I think would be really beneficial. And the other thing that we're seeing too is more strategics and private equity deals. And those absolutely have to happen. Those vintages are extremely long in the tooth. So when I think about that, I think of, more of your pure play investment banks like a Moelis, where, they really have a great position with private equity to sort of do some of these transitions and create liquidity for their LPs.
Yeah, and interesting. And of course, a big transition about to take place there at Moelis as well. Julie, always a great conversation. I have to leave it there. Julie Biel is the chief market strategist over at Kanye Anderson Rudnick. We do have some breaking news crossing the wire right now, Alex.
Yeah, taking a look here at President Trump poised to repeal Biden's curbs on power plant pollution. Now, these were curbs that the EPA, the Environmental Protection Agency, was going to enforce that limits greenhouse gas emissions for power plants. That may be unwound as soon as Wednesday. This is according to people familiar with the matter. Remain. All
right, a lot more coming up on the big program, including a preview of tomorrow's Consumer Price Index report. JPMorgan's chief economist, Michael Feroli, he'll be stopping by the program in just a second.
And plus, speaking of groceries, J.M. Smucker shares in a jam, get it, after the packaged food company reported underwhelming first quarter results due to, guess what, tariff pressures and coffee prices. We're going to have the spread up ahead.
They don't write those puns for me. Also, the U.S. and China resuming trade talks in London today. Hopes that your trade war might actually be easing. We're going to get some insights out of Marissa Adams, the regional head of global trade solutions over at HSBC. That's coming up here on The Close. This is Bloomberg.
Small business optimism bouncing back slightly in May. Business owners still feeling the heat, with nearly a fifth citing taxes as their most single important problem. We're going to get a fuller picture from consumer price data tomorrow. I want to bring in Michael Feroli, chief U.S. economist over at JPMorgan. All right, Michael, what are we going to get tomorrow?
So we're looking for the same number as consensus, 2/10 headline, 3/10 core. So we don't think we're yet going to see the biggest impacts of tariff pass-through. We think that's probably more a June-July story. But, that's why they play the game, right?
So if we get that consensus number, is that a dovish number? Is that a hawkish number? Is that a Goldilocks number?
I think it's a number that doesn't really change next week for the Fed. The Fed has been very consistent in saying they want to wait and see what's going to happen here with the tariffs, how it impacts the economy. I think if we get something like we in consensus are looking for, it's not going to tell you anything too decisive just yet, nor would I expect it that early.
Well, that's what I'm curious about. Like, when does it tell us something? And I mean, as an economist, is inflation typically a ramp up, or is it kind of a shock that just kind of appears one day?
So the evidence from the 2018-19 tariffs was that most firms passed it through within 2, 3, 4 months. So that's what we're kind of expecting this time. And there's actually been some survey evidence from both the New York and Atlanta Feds suggesting that's probably the time frame to look for. So that's why, again, we could see something tomorrow, but probably more likely a little later in the summer.
Later in the summer. And it was interesting, we had the NFIB small business data today. Optimism up, but they also pointed out in that report that the largest share of folks in that survey are anticipating that they're going to raise prices over the next 3 months. So that would at least lend some credence to maybe that we could see some elevation, right? Going forward.
I think we're seeing that in a lot of surveys. So that's pretty firm expectation of ours now.
We have seen surprises, though, for inflation in Europe and the UK.
Yeah.
Is there a difference between us and them when it comes to...
Well, they're not imposing tariffs, right, by and large. So that, I think, is the biggest difference.
They kind of are in response to, right?
Yeah, we haven't seen that much in the way of retaliatory tariffs quite yet. So, but that's certainly not something we could rule out down the line. But right now, I think we're looking at a pretty different picture between the U.S. and a lot of its trading partners.
What about PPI? So what was so interesting was, I know you're going to talk about companies, but Smucker's coming in and talking about how much they were getting hit by price increases, by tariffs, but also by coffee prices, et cetera. Do you think we're going to see a real disparity between PPI and CPI? So
PPI could get affected in two ways. One is the imported inputs that a lot of producers are using. The other is that some producers, domestic producers, may see this as an opportunity to raise prices if their competitors from overseas are also having their costs go up. So we certainly saw that, again, going back to the 2018 tariff trade wars then, when we imposed tariffs on washing machines. Domestic washing machine prices also went up. So that's something I think we could watch out for in the PPIs.
I am curious also about kind of the 1-2 punch of what's been going on with tariffs and now this tax and spend bill that's working its way through the Senate. There are a lot of provisions in there that could potentially be revised, but there are two big ones in there. Obviously, one having to do with the fact that the tax cuts aren't necessarily paid for, and also this provision that is effectively going to end up being kind of a tax on outside capital. And there's been a lot of discussion here about that could have a major economic impact on the U.S. Can you explain that?
Yes, certainly. So it's a Section 899, which basically imposes taxes on foreigners who own or who are receiving U.S. source income. And we think economically that should raise the cost of capital for firms that rely on outside foreign capital. So that could be a headwind to investment here in the U.S. In addition, we do think it probably is weighing on the dollar, or could weigh on the dollar and put upward pressure on interest rates. So it could also affect the economy through its effect on financial conditions, but definitely something we're keeping a close eye on.
Is that going to be material, though? And I mean, because when I read about that, I think, okay, this seems like it's just kind of like something relatively minor. Yes, it has an impact, but we're not going to see like a big drop in GDP or economic activity because of it, are we?
Right. I don't think so, right? Because at least initially it's going to be 5% and then potentially ramp up to 20%. And it's on a subset of countries, right? It's countries that have taxes that we think are unfair, like digital sales tax and so forth. So it just depends on the scale, but certainly you can envision scenarios where, in the worst case, it actually would have an impact. And I think there's also sentiment channels here that we have to think about. If foreign capital flees en masse from the U.S., that would be, which is not what we're expecting by any means, but I think that's a channel where you could see more of a larger impact than what we think is the most reasonable case.
I think I asked you this last time. How hard is your job right now? Like, how often and quickly do you need to redo your models based on all the ifs that we've just talked about for 6 minutes?
We're getting used to it. It's been a couple months now, and so I think there's I think we've also feels like we slowed down the pace at which tariffs are being revised. We obviously have this big, beautiful bill making its way through Congress, and when that, we'll see the final shape of that. We're not expecting to see anything in the next few days, so I don't expect an imminent revision there, but there's definitely a lot going on right now.
How do you model, say, deficits and the impact of deficits on future growth based on what we know in that bill?
So, I think the primary impact of higher deficits and debt is that it is crowding out private capital. In other words, it's raising interest rates to attract buyers of this debt, and that in turn raises the cost of capital for private companies and therefore could discourage investments. I think that's the primary channel that we're looking at, and I think we see it in the behavior of the long end of the curve and things like term premia. So I do think it's already, somewhat in the price, and one of the things that is, weighing on the housing market, to name other areas.
Just real quickly, though, particularly when it comes to what we're seeing in the Treasury market, and there's been a lot of discussion about what's happening with the longer end of the curve, whether there's a real buyer strike. There was an interesting note out today by, I think it was maybe Morgan Stanley or BNP Paribas, to kind of talked about the idea that don't necessarily expect an increase in that term premium on the longer end because a lot of the worst case scenarios, at least from a fiscal standpoint, are already priced in.
Look, I think what we all know what's happening in Washington, right? It should be in the price. But of course, we could get worse news on the deficit, right? Those projections don't assume any recessions, any wars, any of the things that usually really add to deficit.
Just real quickly, but this gets to Alex's point too about how difficult your job is. How much can you rely on those projections coming out of Washington, whether it's out of the White House or even the CBO, which is supposed to be nonpartisan? A lot of people are looking at these numbers and these projections or lack thereof and saying, I don't buy it.
So I think the CBO is a pretty honest scorekeeper. They are constrained by certain rules and what they can assume and not assume. You can adjust for that. But I do think the CBO's numbers, once you understand their limitations, are a good starting point. And you have to start with something, right? You can't just throw up your hands.
All right, Mike, always appreciate it. Michael Feroli is the chief U.S. economist at JPMorgan. And of course, we do, Alex, get that CPI report 8:30 a.m. out of Washington tomorrow morning. Looking forward to it. And to your point, it was BNP that talked about, go ahead and buy the 30. But then the same, on top red, you saw PIMCO saying, no, we want to stay with the 5 and 10s, and that like longer term globally long end debt, we're still worried about deficits and we're worried about tariffs and worried about growth. So we don't want to touch them. So that's, I guess, how you make a market. And it gets to this idea, too, that there really is not consensus here, and it gets back to that interview we had. It was a few weeks ago with Leon Cooperman. He was kind of like joking, like I've never actually met a bond vigilante. The bond market doesn't really always work in unison like that. One thing that is not working today, of course, are shares of J.M. Smucker. They went public back in '88, and today they're having their worst day on record. They've been raising prices on some of their key products for the last few months, and they say they're going to continue raising them because of tariffs. It's our stock of the hour, and it's coming up next. This is Bloomberg. J.M. Smucker, that's our stock of the hour. The share has seen their biggest drop since going public about 40 years ago after saying tariff-fueled cost increases in its coffee business are going to hit profits. Tomorrow's consumer price data, also increasingly important. Let's bring in Isabelle Lee of Bloomberg Editorial to talk a little bit more about this. And Isabelle, a 15% drop in the stock, all because of tariffs. And we should point out, they've been dealing with this tariff issue now for longer than just, the last quarter. So what's going on? I think it's a confluence of factors. By the way, that 14% drop is the biggest intraday since data going back to 1988. And it's a confluence of factors. We have tariffs, but we also have increasing prices of coffee and Folgers. I was going to say, Alex and I were talking about Folgers earlier today. Folgers. I'm going to sing the jingle. Just wait. J.M. Smucker, which owns Folgers and Café Bustelo coffee brands,
generated a third of the revenue from coffee. And we're seeing coffee prices increase also because of a confluence of factors like increased demand, climate reasons, climate disruptions, trade complications. But they're generating a third of their amount from coffee. And since last year, they've increased their coffee prices 3 times. And they plan to increase it again in August. And of course, you can only increase so much. Consumers will pull back.
I mean, but like, really coffee? Like, do we say coffee and mean it? I mean, that to me is not coffee. That's like fake coffee. But this is a whole different. Okay. I'm coming in strong.
That's Alex's op-ed for the day.
Welcome to my TED Talk.
Another thing that's contributing to the weakness, thank you, I would like to attend your TED Talk, is the weakness in the acquisition of Hostess, which is a brand it acquired in 2023, in the dog snack category. And this is what shocked me the most because I thought in this country.
We loved the dog snacks.
Exactly. You see Petco
That's not
report
doing
earnings.
well?
The dog snack category, yes. Maybe the snack isn't amazing. It's not doing well.
It's not.
What?
And then Petco struggled. So what's up? Are you dog owners just like abandoning your pets, or are you just going to Amazon or something?
No, I think we have more dog snacks in our house than human snacks. So I don't know.
So what's up with Wolf and then Jam Smucker?
So they're not doing well with dog snacks. So human snacks, Hostess, is that not doing? Everyone loves Hostess. What's happening?
Because consumers are pulling back, number one, and they're becoming healthier.
No, I don't believe that.
Yeah, they are.
No.
McDonald's is also not seeing a good day because they were slapped with their first sell rating because people now want the healthier option. So Jam Smucker, they're known for Smucker jams, Jif peanut butters. I personally, when I buy peanut butters, I look at those without sugar. Or those that are, quote, healthier. And Hostess, they acquired it in 2023. They're known for Twinkies, Ding Dongs. Donuts, donuts.
Oh yeah, those Hostess cupcakes are so good.
Exactly. So then, if you're health conscious, you're not going to be buying those products anymore.
I don't see the problem.
Or if you're not 15, you're going to go buy something else with less sugar. What's so interesting to me, like all joking aside, is that why do some companies stress the tariffs and others don't when they're all maybe in like the same business? That's what I find really confusing. And how much are tariffs obscuring other issues maybe? Like you were mentioning, a shift to, say, healthier products.
And some companies will say that we don't know what the future holds, but some companies will provide even dual outcomes. Like this is our base case with tariffs and our base case without tariffs. I feel like, honestly, investors prefer those with at least a little bit more clarity rather than, I don't know where this is going.
Right.
And that's exactly kind of what we're seeing here, which is why we're seeing the big slump.
All right, Isabelle, thanks a lot. Really appreciate it. Thank you very much, Bloomberg's Isabelle Lee joining us. I know you don't like chocolate, so Hostess cupcakes are out for you. But were you a Twinkie guy?
No, I was actually, when I was a kid, I liked the cupcakes, the regular cupcakes.
Yeah, where you just peel off the top and
I did not
like
that. I did not like that
icing?
little like fondant or whatever they put on
So
top.
good.
But the cake was good.
No,
and the cream in the middle.
You need the fondant.
No.
It's like it just roll it right off.
That's a little too much.
It's a little too much. Okay.
I don't know.
Well, maybe if they put in like, gummies or something. Okay. Anyway, coming up.
I could see a rebound in the shares.
We're going to head to D.C. Brian and Bernasek is co-head of private equity for the Americas over at Carlyle. They have an annual Washington Day where they're going to advise clients and their LPs how to manage current uncertainty. How much do you sit on the sidelines? How offensive or defensive do you have to be? Taking a look at the markets here, the S&P is up by 0.5%, off the highs of the session, but still kind of moving higher as we head into the last half hour of trading. And the Nasdaq outperforms up 0.6%. Volume a little mixed. This is The Close on Bloomberg.
We have a very positive view of the future here in Europe. We think we're going to be able to invest $500 billion over the next decade in Europe. We see it as a major opportunity for us. They're starting to change their approach here.
Stephen Schwartzman speaking a little bit earlier today at just about 3:30 p.m. here in New York. You are watching the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele. And Steve, really echoing what a lot of investors themselves are talking about, which is moving money into Europe, how much you sell out of the U.S. TBD, but moving into Europe as that value opportunity. And like it's sort of Europe's race to lose then at that point.
Europe's race to lose, and it really becomes a question, too, as to what's going on. Is this sort of a direct effect of what we're seeing in Washington right now?
Right, or is it something else altogether and you just need to diversify out of, say, U.S. tech names, for example? Let's stay in the private equity space. Today, Carlyle is hosting their annual Washington Day. Now, the event will bring together the firm's clients with policymakers from the Hill and the administration as they look to make the most out of Carlyle's bipartisan ties across Capitol Hill. Joining us now to discuss is one of the men in charge, Brian Bernasek, a co-head of private equity for the Americas over at Carlyle. Hey, Brian, really good to see you. Thank you for joining. What are the themes
nice
you guys are going to be?
Very nice to see you.
What are the themes you guys are going to be addressing today?
Look, I think the themes here that we're most focused on is getting that group that you mentioned, some of our most significant investors, together with our team and in front of a number of the leading policymakers here in Washington, folks from the administration, folks from the Hill, just general policymakers, to share views on what is happening here and what insights and relationships we can share to head in the right direction.
For your LPs and your clients, like, what's the number one thing that they're worried about, and then how do you advise them to manage that?
You know, I think the number one thing folks are focused on here is where do we find certainty and a path forward. And I tell you, based in Washington on the ground here, which, you know, as you know, we're headquartered in Washington. About a third of our people globally are based here. Our headquarters is right in between the White House and the Capitol. And that's really beneficial for getting a sense of that direction of travel and where things are moving. And what folks are focused on is what's the certainty, where are we headed going forward? And what we hear from people in town and those relationships that we have in quiet conversations is that there's steady progress. You wouldn't see that from the headlines, but our view is that there's steady progress because folks are focused on those midterm elections. People want to make progress, move forward, communicate that to the folks that might elect them here in 18 months.
Where, though, is the progress? And I guess let me flip that around, Brian. Where is the biggest concern right now? Is it trade? Is it sort of the fiscal issues? Is it kind of all the other sort of non-financial related stuff that's been going on? What?
Yeah. I think the number one concern that would take more time to settle through is the tariffs. Now, there's a lot of progress, just the fact that folks are talking as they are in the last couple of days, but that progress is awfully important. But I say the number one concern, as we see it, is really inaction. You know, our view as we work closely with our companies and portfolio companies is moving forward and making good, smart moves for the long term, controlling what you can control and operating as long-term investors. And that means making decisions for the long term, not getting wed to what might be happening in the daily news today, the noise. Separate the signal from the noise, if you will.
Well, in fairness, though, it's kind of hard to do that because there's a lot of noise, Brian. And I mean, look, I worked in Washington for years. I understand the theater of it all. But what we're seeing, at least over the last few months, is on a scale that I don't think anyone has seen, at least in their lifetime, period. So the question becomes, how do you separate the wheat from the chaff? How do you even know what's noise and what's real?
Well, I think there's a huge benefit to us being based in Washington and separating that signal from the noise. And as I mentioned, hearing directly from folks of where the progress is. And we do see light forward and reason for optimism. Now, you have to be very careful about where you do invest and how you manage your businesses. Close to 85-90% of our businesses are not impacted at all by the tariffs, for example. We bought businesses that are service-based, technology-based, financial services-based, that don't have the trade flow impacts from tariffs, for example. And we see great opportunity in this as well. So, for example, we see real opportunity to invest in government services in support of national security. That's been a place where we've invested for a long period of time, and we see a level and a step up in that area over the next 18, 24 months and beyond, given the bipartisan support for those efforts going forward. We see that as an opportunity. We see an opportunity in Europe for sure, given the geopolitical challenges that are there on the industrial and the defense space. And look, in a macro uncertainty period like this, there are going to be more corporate carve-outs. There always are, and there will be here. And we're especially well positioned around those opportunities. So it's about thinking about the long term and investing around that.
When we talk about private equity in general, there's a lot of conversation about exits. Exits are really hard. You can't get out of investments. That's why secondaries are really heating up. Is that true from where you sit?
Well, look, I think we have been very active and very successful in our exits over the last 18 months in the U.S. We've returned about $12 billion of capital across the funds in that period, and our pace continues to move forward in that direction. There's no doubt that it's a harder time to do that in general, but if you invest in good businesses, you make them more valuable, others would like to own them. And we've been able to take companies public. We've sold secondary shares. We've sold companies to private sponsors, to strategic buyers across the board. And look, you know, the one thing you can be sure of, Alex, is LPs are very focused on getting returns of capital, and so are we.
Is that opportunity set, exit strategies, for example, as open as you thought it would be at this time, say, 6 months ago? Or do you feel like it's on par? And then what's your outlook for the back half?
Sure. Look, I mean, at the beginning of the year, I think most everyone was pretty optimistic and bullish about the future and where a pretty robust year ahead of us. I think we saw that slowly fade to a little less likely of such a bullish year when we looked into January and February, and certainly around Liberation Day. But we're seeing that slowly creep back up to being a more active, where buyers and sellers are joining together and where there's more opportunity going forward. So we're pretty bullish, not only on that exit path that I mentioned, where we're focused on DPI, but also on some pretty interesting new deals in the power alleys that we have, where we have some pretty unique edges. So I expect you'll see a better second half, because the markets look good, the financing markets are good, and I think you'll see, as I mentioned, some progress on these big issues in Washington that will clear the way a bit.
I am curious just about the appetite for companies to even go public. If we want to talk about IPOs, I know the window is opened up, but there's been a lot of discussion about whether there's even a need in this point, given that there is greater access to capital in the private space, that maybe you don't necessarily need the cost and the hassle of becoming and maintaining yourself as a publicly traded vehicle.
Well, I think it's what we believe is we like to have options, and we like to have options in lots of areas. Certainly, the private markets are quite robust and have been for some time. And as an alternative asset manager, as we are at Carlyle, we're certainly very bullish on that path forward, and we see lots of opportunity in the private markets. But there are special businesses that the public markets are going to value, that will become a currency for that particular business to move forward and do more aggressive things going forward. And we've seen that in a number of businesses. Look, Standard Aero is a great example. It's an aerospace business focused on the repair of aircraft engines. We bought it before COVID. We worked really closely with it through COVID to really drive change in that business with operationally doing a bunch of significant M&A, and we took it public, and it's been performing exceptionally well. And I tell you, the public investors who are in that are very happy that we took it public and that they're investors there.
Hey, Brian, what's your biggest concern right now? Like, you seem pretty optimistic, you seem constructive, you seem engaged in terms of getting stuff done. What's the worry in the back of your mind?
You know, I think we're worried every day about just what we can control and driving important performance in each and every business that we have. And that's what I spend most of my time focused on, is investing in good businesses that are ones where we can drive value in it and we can attract world-class management teams to those companies, and that we have a profile and a plan to drive positive change in each and every business. And that's what I worry about, is what I can control. And that's frankly what the whole team worries about, what we can control.
All right, Brian. Well, great to catch up with you. And of course, even before now, I think for a lot of folks, Carlyle was already synonymous with Washington. And now, of course, pushing deeper into that, we'll let you get to your very first Washington day for Carlyle. That's the co-head of private equity for the Americas at Carlyle. As we keep it rolling here, closer to the closing bells with just about 20 minutes to go, let's get to our top calls, some of the big movers on the back of analyst recommendations. And we start off with McDonald's, a third downgrade in as many days. Redburn today joining on the pile-on, becoming the one of only 41 Wall Street analysts tracked by Bloomberg to assign the stock a sell rating. Redburn saying that weight loss drugs suppressing consumer appetites. It also dropped the price target to a street low of $260 a share. The share is down about 1.5%. Next up, Booking Holdings, BTIG, upping the price target to $6,250 from $5,500, saying macro conditions have stabilized. The analyst also sees a steady pickup in reservation volumes that puts Booking on track to top its 2Q guide. Those shares, though, down about 1.3% on the day. And finally, Disney, Loop Capital nudging its price target to $130 from $125 and keeping a buy recommendation. It took a look at that latest Hulu deal, and Loop says Disney taking full control of Hulu will let it to fully integrate the streamer into Disney Plus, as well as the upcoming ESPN streaming service is set to launch in a few months. And though you see the shares up about 2.25% on the day, and those are some of our top calls. All right, let's stay in the media space right now, because the main union representing voice actors has reached a tentative contract agreement with video game developers. Now, this potentially ends a strike that has dragged on for almost a year amid a big dispute over the use of AI in the gaming industry. You can see EA, Take-Two, Roblox, all moving fractionally higher on the day. here to discuss that, as well as just the broader video game ecosystem, and really just an excuse to talk to him about anything, is Michael Pachter, Managing Director, Equity Research at Wedbush Securities. Michael, always great to talk to you. We're always looking for a news peg to bring you onto the program. So let's start with this deal. I didn't even realize they were still on strike. And this actually goes back even further than just when they went on strike back in July. Give us a sense here as to what was actually being hashed out here. The general idea was that the actors were uncomfortable with the idea that video game developers were leaning a little bit more heavily on AI for work that would traditionally go to human beings.
Yeah, and it happened obviously in Hollywood with film as well, and I think people understand that replacing an actor in a film with a CGI image is easy to do. Games are all CGI images, so what really happened here is the voice actors who do what's called cut scenes. They do the part of the game between levels of the game where they kind of give you the transition, where you're going and why you're going there. They were really worried that their voices were going to be programmed. And probably the most famous game that has cutscenes is Grand Theft Auto. You'll see in the next one that you're going to go from a mission in Miami Beach to a mission in the Everglades to a mission in, they call the state Leonida, but North Florida. They have to get you there. And so the actors set the tone. You get the bosses telling the underlings what to do. And it really is acting. It's interesting to me because I've actually talked to a whole bunch of developers about their favorite part of making video games, and they said directing the voice actors. They get to work with real professionals and get them to have the emotion that they're looking for in the game. Those people, SAG-AFTRA members, were worried that they were going to be replaced by AI, and rightfully so. I think the games industry was behind the movie industry and didn't realize how important those people are to making high quality games and how little they cost in the scheme of things, because these actors make $5,000-$10,000 for a piece of work, and a game costs literally upwards of $100 million. Grand Theft Auto over $1 billion to make. Who cares about paying 20 or 30 people $10,000? Well, the actors care very much. The game companies gave in.
All right, so what does that mean for the actual gamers? Like, how much does it wind up hurting them or not?
Gamers, I think, are just going to get a better experience. So, there's a fine line between realistic and too realistic. Some of these games are pretty violent, and sometimes it really does feel like you're killing somebody. I played a game called Fallout. I actually loved the perk where I could shoot at a ghoul's head and it would explode. But now they're making the ghouls Walton Goggins. He's in the TV show. He might be in the next Fallout game. They have Keanu Reeves in Cyberpunk. I don't know if I want to shoot Keanu Reeves. Norman Reedus in Death Stranding. He's the guy from The Walking Dead. So I don't know. It gets too real sometimes. But if the main character, the good guy, has a voice that you recognize, that you trust, what's his name? Kiefer Sutherland did the voiceover of the main sergeant in Call of Duty. That adds a lot of value. And the number one download in the 2000s for any game was Snoop Dogg doing the voiceover for Call of Duty. People love something familiar. That's why we have actors doing commercials.
Well, that's what I'm curious about, too, about how this evolves, because we kind of forget that some of these voice actors, and I'm just talking about the big celebrities, have become celebrities in their own right. And I'm curious, is there going to be space for that unknown person to voice something like this and basically elevate themselves? Or is it now just going to be the Snoop Dogg's, the Kiefer Sutherlands, et cetera, Keanu Reeves, if you will, Walter Goggins of the world, and AI?
That's a great question. Everybody can't, be Snoop Dogg, and not every game can afford Snoop Dogg. So there's always room for just really good actors. And I think it's going to be similar to commercials, television commercials. The voice actors in most of them are nobodies, except they're talented, and they actually can sell you the product. And I think that's what you're going to get mostly in video games. Occasionally they want that voice you can trust, so it'll be the voiceover in State Farm or something will be an actor that you recognize. But no, I think that there's plenty of room. And again, there are people who make a living doing voices in games. The other aspect of this was motion capture. And those people are supremely talented. Essentially, they're stuntmen doing the physical actions. And the guys like in Madden NFL, you want your player to look like an NFL player. They hire NFL and NCAA
Michael?
players to be those people. Yes.
Michael Wilberg, it's a heartbreak. Got to leave it there. Really appreciate it. Always good to see you. Michael Pachter, Managing Director, Equity Research over at Wedbush Securities. 15 minutes until the close of trading. Equities holding on to their gains. This is Bloomberg.
10 minutes until we get to the closing bell. Romaine Bostick here with Alex Steele. Fractional gains on the day, but a third straight day of gains nonetheless.
Yep, and you're still seeing like the Russell small cap stocks up fairly strongly. You're also seeing a divergence in the under the S&P. You're seeing energy outperform, but then industrials not. So it's hard to get a real narrative on what that actually means. Sure, we get maybe positive headlines out of Howard Lutnick, the Commerce Secretary, that talks could continue into tomorrow, or they could wrap up today. But nonetheless, it's hard to get a strong read through on the overall market narrative.
Yeah, the only thing that seems to be consistent right now is you're still seeing strength in chip stocks. But I agree. I mean, you put it all together and it doesn't not really paint a picture of anything. It's just kind of a hodgepodge, Alex, but maybe that's okay.
Is it?
I don't know.
Or at one point, like, does the hodgepodge lead to higher equity prices, or the hodgepodge lead to complacency?
Yeah, absolutely. Well, you see the numbers on your screen, and that gives you a sense of some of the complacency here. You also, you don't have it on the screen there, but of course the bond market not doing much of anything right now. The VIX subdued, actually falling today, back below 17 as we count you down to the closing bells with just about 9 minutes to go. Let's bring in Mandy Xu, Vice President and Head of Derivatives Market Intelligence at CBOE Global Markets. Mandy, great to see you.
Always good to be here.
All right, let's start off with the VIX, because I am curious about this. We talk about this idea of complacency.
Yes.
And there's a lot of metrics in this market that I think do scream that people maybe are either complacent or maybe they're just absent. I don't know. When I look at a VIX below 17, given everything that's been going on, what is that telling me?
So not only is the level of the VIX low, it's also low compared to the recent level of realized volatility in the market. So what that is telling you is investors expecting this calm to continue. There's really not a ton of hedging going on, at least in the near term. Keep in mind the VIX is really just a measure of 1 month implied volatility. And if you want to talk about low, look at VIX EQ, which is our measure for VIX for single stocks. That's currently at a year-to-date low. So VIX index has retraced significantly from the April highs, but it's still higher than where it was in January, February. Single stock volatility currently is at a year-to-date low, and that's telling you that people still believe corporate fundamentals are strong in this environment.
They're strong in this environment. When we look at the technical measures, momentum, particularly, and some of those other measures that had been driving this market higher, is that still there, particularly in light of some of the, I guess you can say, tepid moves we've seen over the last couple of weeks?
Yes, I mean, I agree with, you guys take that. People are struggling for direction, but I would say even here, the pain trade is still higher. And that you can see this in the positioning in the options market, where, again, in the near term, it's much more biased towards calls. So there's really not that demand for puts, and we're still seeing that incremental demand for upside calls. That really changes if you go out longer in the term structure. If you look at like 6-month options or even longer, we're seeing a lot more demand for hedging. So in the near term, I definitely still think that the pain trade is higher. People de-levered in April, maybe didn't get fully back in. We know retail was there, but I don't know institutional investors have really re-levered. And therefore, I think the pain trade at this point is still higher.
If volatility stays relatively subdued, do funds then also need to start re-risking, like volatility funds, CTAs, et cetera?
Yes, so there are some funds, like the more systematic strategies, whether that's CTAs or some of the vol target funds, where they have an explicit level of volatility that they're managing towards, therefore as realized volatility. And the key thing here is it's realized volatility, not implied, but as that continues to fall, you would expect to see more and more allocation towards equities.
Hence, the risk is to the upside, the melt up kind of scenario also. You were mentioning, though, that individual options for stocks was also really low. Like, why is there the belief, or like, do we believe the belief that corporate fundamentals are holding up?
I think right now, earnings revisions have been fairly positive. I mean, earnings season, we just went through one. Obviously, it's not going to reflect the trade war, and that's going to be, an ongoing, risk. We'll see what comes out of the U.S.-China talks. But so far, at least, and at least for the mega caps, which is really what's driving that weighted average single stock vol, investors are still pretty positive on the outlook for corporate earnings there.
Let's go outside the U.S. because we know this was a big part of the trade, at least for the first few months of this year. This idea that more people were sniffing around in emerging markets, obviously in Europe, and we saw that outperformance. I know that outperformance has waned a little bit if you just look at it from the last 4 weeks, but on a year-to-date basis, it still stands.
For sure.
Is the volatility the same?
No, so it's interesting. So for the first time in a long time this year, U.S. stocks have been more volatile than, say, emerging market stocks. Not just on a realized volatility basis, which obviously reflect what went on in April, but even if you look at currently the implied volatility of, like, say, S&P compared to MXEF, which is the MSCI EM index, S&P is still implying higher levels of volatility than emerging market stocks. And I tie that to what's going on in the fixed income and the currency markets where, the U.S. Treasuries and your dollar very much behaving like how an emerging market economy would, right? Higher bond yields, but weaker dollar. So that you're really seeing also reflected in the equity volatility market.
How do you chart a path as to whether that volatility will subside, particularly when we talk about what's happening in bonds and in FX? Because we know a lot of that is tied to decisions and words said out of Washington, let's just put it that way. And that's not something that's easy to predict.
No. Definitely not. And I think, again, going back to the lack of conviction, what we've seen coming out of April. So April obviously was a great month in terms of options trading, option volume. What we've seen post-April, and May particularly, is a very significant drop-off in longer dated option volume. And that kind of tells me people are really struggling for that direction. And where we've seen really a resurgence in terms of volume and activity is in zero-day options, right, which is playing on a totally different factor. It's not really where the market is going. It's more intraday risk premium, and that is driving a lot of the option activity.
Where is hedging then still cheap? I mean, it seems like from what you're saying, like everything is going to be cheap.
From an absolute perspective, yeah, like single stock volatility, year-to-date lows, VIX, I think 16 last time I checked. So in terms of if you are looking to hedge, I think the premium that you're going to pay now is definitely a lot lower than it was, a month or even 2 months ago.
What do you think changes the calculus? So if the risk is to the upside, like that's where the melt-up risk factor is, that's the pain trade. What changes it?
So I think a couple things. So obviously what's coming out of Washington, if we do get a re-escalation in terms of the trade war, I think a lot of people have really written down that risk. I think a lot of the optimism around trade is I think already priced in. And then the second thing is obviously, U.S. the strength of the underlying U.S. economy. So far it's held up.
Data, basically.
Exactly. And so far that's held up, and that's why I think the market's kind of, almost back to all-time highs. But if that were to change, that certainly will change volatility levels.
But this also gets to this idea of whether we are in a situation where we could be range-bound. Because so much of the risk we feel like has been priced in. Some of the upside we also feel like is priced in. So if you don't get a big shock either to the upside or the downside, does this mean we just kind of drift along where we've been for the last couple of weeks?
I can see that, and I think you definitely can make a case for that. And then the case for the bullish scenario would be just the positioning is not there yet. Like so many people have delevered and have been really chasing this rebound, and where they are now versus, beginning of the year, I would say people are still more underweight equities.
If you had to just make a decision and say, is this a market being driven by fundamentals or being driven more by technicals? Which one?
I still think at this point it's fundamentals and the fact that the U.S. economy is still all the data that's coming out is still so strong and earnings revisions still so strong. That's why we're back to kind of the highs. But again, hard data is going to be a lag, right? So we'll see, I think, in the next couple months.
All right, Mandy, always great conversation. Always great to have you in studio, too, here. Mandy Xu, Vice President and Head of Derivatives Market Intelligence with CBOE Global Markets here with the S&P 500, now up about 0.5%, right around the highs of the day, Alex Steele. Of course, these are fractional gains, but you're seeing outperformance in the transportation space. You're seeing outperformance among semiconductors here. Not a whole lot of weak spots, and I guess that's a good thing.
Well, interestingly enough, Charlie McGilligot over at Nomura, and I love his notes because he talks a lot about the fund positioning. Yeah. He was saying if we continue this 50 basis point daily change within the S&P in that environment, you're going to see a lot of buy coming from volatility-controlled funds in the ballpark. He says about $62 billion to $177 billion over the next 2 months as we kind of wait for the risk and the volatility event. Yeah. So you could see some material buying if things stay calm.
Yeah, absolutely. We talk about what's moving in the market today. You have about 170 stocks down in the S&P. Some big names are down. You have Microsoft, you have Netflix, you have Salesforce, all in the red. But then you have monster gains from Tesla, up about almost 6% here on the day. Meta up 1% on the day. Alphabet also getting in on the action as well. As we move closer to the closing bells with just about a minute to go, we want to bring Scarlett Fu into the conversation as we do every day at this time. And also joining us here around the desk in Studio 2 is our very own Emily Grafeo to help us break down all of the day's market action. And Scarlett, not an exciting trading day, but you're putting together these small gains, and I guess that's good. Tell me you're half glass full.
I am half glass full because Alice was saying if we continue to get these 50 basis point days, eventually we'll get to that record high. It might take a few of those and consistent melt up, but it feels like we're getting there, although the catalyst still remains what comes out of these trade talks, which are ongoing right now, right? They have continued to move forward with it, and we're not clear whether it's going to wrap up today or go into a third day even.
We get the closing bells here in New York. Fractional gains across the board on this Tuesday afternoon. The Dow Jones Industrial Average, which very briefly dipped into the red earlier in the session, clawing back those gains to finish higher by about 100 points or 0.3%. The S&P 500 holding that 6,000 level, 6,038 and change to be precise, up about 30 points or a half a percentage point. The NASDAQ Composite up about 0.6%. Similar move for the NASDAQ 100. But the big gains today, you actually saw that in the transports, up 1.3% here on the day. You saw railroad stocks, you saw airlines moving higher as well. The Russell 2000 higher as well, up 12 points or 0.6%.
Yep. Fastenal hit a 52-week high. Unlike, I didn't see any news. They haven't even reported earnings at the end of the day. Taking a look at the S&P here, you're seeing 333 stocks advance, only 168 are declining. But a fun stat for you that the average for the S&P 500 members is still 23% below the record high. So even though the overall index seems to be grinding higher day by day, overall you're still seeing broad-based I want to say weakness, but just not a lot of momentum.
Not a lot of momentum. Well, you take a look at the IMAP, and there's a lot of green on that screen right now. 10 out of the 11 sectors finishing higher, with at least 4 groups finishing with 1% gains. Energy, consumer discretionary, healthcare, and communication services. The laggard on the day is industrial, is the only sector to finish in the red, down by 0.4%.
Yeah, totally. And then taking a look at some of the individual movers as well, as I mentioned, Fastenal, for example, hitting a 52-week high on absolutely pretty much no news. All right, Emily Grafeo, you were looking at some of these winners.
Yeah, that's right. Looking at the gainers here, Disney up higher after Chief Executive Officer Bob Iger said he has no plans to divest the company's traditional TV assets. This, of course, is bucking a path pursued by rivals recently as consumers' media preferences shift towards streaming. We saw Warner Brothers Discovery saying it's going to separate its legacy media channels from streaming.
I thought it was interesting, too. They had that Hulu deal yesterday, which kind of flew under the radar, right?
Yeah.
This idea of the other $500 million or whatever they're paying out to kind of take full control of that, and how that kind of folds in to the broader idea of whether there could be more spin out. But then Iger basically saying, look, that ain't going to happen with us. I don't know. How long is Iger supposed to be around, Scarlett?
It keeps getting pushed off, right? So for now, I think it's just like
He's on the Jamie Dimon plan.
Yeah, exactly. He'll leave when he leaves here. But yeah, Disney a big gainer. Eli Lilly also having a good day, right?
Yeah, that was another one. So they're now only going to be working with telehealth firms that agree to stop selling copycat versions of weight loss drugs. So this is diminishing the likelihood of a partnership with one of the most visible players in the industry, Hims and Herms. They had teamed up with Novo to offer the rival GLP-1 from Eli Lilly, Wegovy, at a discounted price to patients who use the platform. So investors here looking at this being a positive here for Eli Lilly.
All right, let me just jump in because we do have earnings. It's hard to believe, but we do have earnings, and it comes from GameStop. Net sales for the quarter dropping 17% from last year. So first quarter net sales of $732.4 million. First quarter hardware and accessories net sales missing analyst estimates. Software net sales, $175.6 million, down 27% year over year. So the one part of the business that did do better, collectibles, $211 million, up 55% year over year. When was the last time either of you stepped foot in a GameStop?
Well, it's been a while. But I guess this idea is sort of what they want to be, right? I mean, the collectibles, that's kind of been the only thing they've hung their hat on. And of course, we remember, was it a couple of months ago when they started talking about this idea of, I don't know if becoming a Bitcoin trust, but certainly moving deeper into that crypto space. And we'll see if maybe that can be the future for this company.
Aren't they like a MicroStrategy now?
Now, no, but I think they want to be.
But they want to be.
Yeah, I mean, they're definitely moving in that direction. Absolutely.
Yeah, go figure. All right, let's get back to some of the other gainers on the day. Emily, what else are you looking at?
Okay, so Insmed. I have to admit, I hadn't heard of this company, but it's a healthcare company. It's a smaller market cap than Disney and Eli Lilly, but the shares climbed as much as 27%. Actually, they finished out the day even higher than that, so higher than 27, about 29%. It was the highest level in over 24 years. The drug developer said that a mid-stage trial of their experimental inhalation powder for the treatment of a type of lung disease met all endpoints. And there were a number of Wall Street analysts that said that the data exceeded their expectations, and they were very positive on this stock. So it was a good day to be long Insmed. Should we get to the decline?
Yeah, let's do it, because there were a bunch.
Yeah, there were. It was actually pretty easy to find the decliners because there was a lot of popular names, a lot of food names. We'll start with J.M. Smucker. Of course, this is the parent company of Smucker's peanut butter, jelly, Folgers coffee. They had a record drop today and also falling to the lowest level since 2021. They disappointed on guidance during today's earnings. Projected EPS will decline 25% year over year. And then they specifically said that the U.S. tariffs are increasing costs in the coffee business, and that's going to hurt their profit.
All right, we are getting some other earnings crossing the wire. This on Dave & Buster's, one of the great tickers on Wall Street, played, but not necessarily a great quarter. In the first quarter, the company said it reported EPS of about 62 cents a share. Revenue for that period coming in at about $567.7 million. Now, that did appear to be a beat. The street on average was looking for about $569 million. But the entertainment revenue specifically did come in a little bit light at roughly about $366 million and change. We should also point out that comp sales overall were down about 8.3% in the quarter, and adjusted EPS did miss as well, 76 cents a share. Scarlett, the street was looking for 94 cents. You see the shares down about 4% in the after-hours trade.
All right, I'm taking a look, guys, at Stitch Fix. So it's like an online personal styling company. Taking a look at the third quarter loss per share, coming in at about 6 cents. Now, taking a look at its EBITDA for continuing operations, coming in at about $11 million. That's for adjusted third quarter. All right, taking a look at its forecast for the fourth quarter, looking at the net revenue from those continuing operations. On the high end, $303 million. Low end, $298 million. That would be a decline sequentially quarter on quarter. Those stocks getting hit, down 13%.
Okay, another stock getting hit right now after these earnings is GitLab. It's down about 9-10% right now. The first quarter revenue did come in slightly ahead of estimates. First quarter revenue of $214.5 million versus estimates of about $213. Adjusted EPS also beat. It does look like, though, they lowered their second quarter revenue. So they now see second quarter revenue $226 million to $227. Estimates were for $227.1 million. And then they still see their full year revenue about where analysts had expected.
And just some news out of Tilray Brands. It calls itself a lifestyle and consumer packaged goods company, but we're talking about the cannabis company. The shareholders have approved a reverse stock split. You like that?
Yeah, that's great marketing.
I think that's what we should all call ourselves. Global lifestyle and consumer packaged goods company. Anyway, they've approved a reverse stock split, but they have paused the implementation as they evaluate the timing and the stock price. So they're looking at anything from a reverse stock split of 1 to 10 to 1 to 20.
I'm actually, though, fascinated by this because remember a few years ago we were all talking about, remember the marijuana stocks were just on fire because everybody was anticipating.
They're the weight loss drugs of the era.
But everybody was anticipating sort of this new regulatory environment in the U.S., not only in terms of being able to sell it, but also in terms of financial regulations to be able to accept credit cards. That never really happened. I mean, you did get some state-by-state deregulation, but you did not necessarily get the cross-border stuff. And then you saw those stocks really just start to dive, and they haven't really recovered. And there's been no real chatter heading into this administration because there was disappointment with the Biden administration and people thought the Trump administration would be more favorable. But at least for right now, they've been distracted by other things.
Yeah. Turns out when you can't do banking at regular banks, your business prospects don't look great.
It's tough. It didn't work out. Also, bonds. They did nothing today, by the way. In case we want
is that your bond update?
Well, there was an auction, right? Bond up. There was an auction 3-year, went okay. Tomorrow's the 10-year. See, I got it in there.
All right, guys, a nice breakdown of today's market action here on this Tuesday afternoon. We're going to say goodbye to Alex Hill. She'll be rejoining us tomorrow. Scarlett Fu sticking around. Our thanks to Emily Grafeo as well. When we come back here on the big program, we're going to talk about the gap between the U.S. and Europe and how to bridge that gap, particularly when it comes to alternative investments. We're going to sit down with the relatively new CEO of the Americas for DWS Group. That's the asset management unit of Deutsche Bank. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another middling day on Wall Street, but it is still 3 straight days of gains for the S&P 500. Fractional gains to be sure, but some people will take it. As far as some of the individual sectors, you did see the Philadelphia Semiconductor Index rise 2%. More meaningful gains there. It's up about 4% over that same 3-day stretch. At the bottom of your screen, keep an eye on a lot of what's been going on in the transportation sector. Railroads actually got a nice big pop today, largely because of some chatter coming out of Washington on the regulatory front, as well as some investor presentations that were made today that seem to suggest that maybe the bottom in some of those freight rates might be in. Meanwhile, Washington chatter actually dragged down a lot of the healthcare names on the day. It's not quite clear what is actually driving this. This is the second straight day that we've seen meaningful declines there. Some of this, Scarlett, seems to have to do with an executive order that was put out about Medicare pricing.
Washington, D.C. driving everything. Now, you mentioned transportation. Let's take a look at Tesla, finishing the day up almost 6% after Elon Musk and other executives promoted a video of a driverless Tesla on the road in Austin. So a pretty clear hint that the company is close to launching its robotaxi service in the city there. According to Bloomberg, Tesla aims to start the robotaxi service on June 12th. Now, Insmed, that company up about 29%. This is a 24-year high. It had gained as much as 30%. Data in its trial of a lung disease treatment topped analyst expectations. In fact, topped the highest expectations according to one firm. And James Smucker, the packaged foods company, falling more than 15% on the day. That is the most ever after its quarterly and full year forecast missed analyst estimates. Why? U.S. tariffs are increasing costs in its coffee business in particular. And that brings us to our top story this hour, which is trade and inflation. These are the two key catalysts keeping stocks in a holding pattern, and U.S. Treasuries little changed. And that's because they have yet to really play out. U.S. and Chinese officials extended their trade negotiations into Tuesday evening in London, though they are still very early on in their talks, given that the issues have really broadened from chip design software and rare earth minerals to jet engines and higher education. Meantime, inflation data over the next 2 days will provide some sign of how President Trump's tariffs are affecting prices here at home. Romaine?
And we're going to spend the next hour talking about that and, of course, the bridge between what's going on here in the U.S. and overseas. We've got a really special guest here to kind of kick things off for this hour to talk about that geopolitical uncertainty. DWS Group, it's the $1 trillion global asset management unit of Deutsche Bank, and it is in a unique position as a bridge of sorts between alternative assets in the United States and those in Europe. Just about 6 months ago, the America's CEO was new. Hepsen Uzcan. She is now the America CEO over at DWS Group, and she joins us today here in Studio 2. Great to see you, Hepsen.
Great to see you as well.
An interesting time for you to take over a unit that I think is probably much more in focus than maybe you even would realize back in December when you took over. A lot has changed, of course, over the last few months with policies coming out of Washington, and more importantly, investors looking for, I guess, something different. What are they looking for?
Correct. First of all, I did come in at the helm at a very unique time. You're correct. It was December when I got appointed. Being a first-generation American, moving over to the United States at the age of 15 with a bag of dreams, I'm extremely humbled and grateful to be at the helm of this organization. Look, it's an exciting time to be at DWS. Over the past 6 months, and I'm not sure if it had anything to do with me, but I think we hit very, very important milestones for our franchise. In December, as you mentioned, we hit a $1 trillion mark in terms of assets under management, which also marked a 10% increase in terms of net flows, right, in 2024. Very remarkable result compared to the others. In February, our share price actually went up to 50 euro mark, which is something that we're incredibly proud of. Our market cap now expanding to 10 billions. And then certainly in March, we've been listed in MDAX. We are amongst the 50 German companies, mid companies. And I think the most interesting thing in terms of the volatility is exactly what you mentioned, Romaine. That is gateway to Europe.
Well, that's what I want to talk about. I mean, you are helming the Americas business. This is a business that is also taking U.S. money, U.S. investors, I should say, who are looking for opportunities over in Europe. What exactly do they want?
We're a very diversified asset manager. I think when you look at our offerings, we provide across active, passive, and alternatives. In the United States, we are deep roots in alternatives, especially in U.S. real estate, liquid real assets, and infrastructure. We actually just had our conference in Scottsdale, Arizona, where we celebrated our 50-year of private real estate platform, rooting back to the Reef brand. And interesting enough, that conference brought over our clients, prospects, and investors, and certainly our investment personnel. And what we are hearing about, they want to hear perspective, different perspective than our America's competitors. And I think that's the advantage that we have.
That's the value add that you bring. And as you position DWS as a gateway for U.S. investors to Europe, I'm curious what the conversations about regional diversification sound like right now. We know conversations have been taking place for a while this year because there's so much volatility, but what does follow through look like? And how much does it correlate with the volatility or lack of volatility in the past couple of weeks?
Thank you for the question, Scarlett. It's certainly an interesting time because when we think about a few months ago, global investors did not have that much demand for Europe. Actually, they were looking at Europe with a lot of skepticism, right? Because they did not see the growth prospect. But I think the geopolitical pressures really changed that, forcing Europe to take action. And what I'm talking about, the reforms and the investments, particularly in defense and infrastructure. And indeed, that's what we are hearing from the clients. Being a leading global diversified asset manager that is European-based and undisputedly being the #1 asset manager in Germany, they really want us to connect the dots in terms of regional perspective and asset diversification. And let's maybe focus back on the alternatives. Certainly, the interest rates have not really been kind to the asset class over the past few years. But with the interest rates changing, we are seeing a lot of interest back into, particularly in liquid real assets, U.S. real estate, and infrastructure.
So those returns, those potential returns, I say, are going to be competitive with what we see in public markets?
We really think so. And we have a deep-rooted franchise that has the expertise to be able to deliver that. I think that our thoughtful leadership is very important for our investors, and that's why they turn to us in terms of positioning their portfolios as they see the opportunities.
But there's a lot of competition in alt space right now. I mean, this isn't like the niche, pocket of the financial markets that it used to be.
Yeah. Agreed, and especially the expansion of alternatives. As a lot of our competitors go into the democratization of alternatives, I think it's a very interesting and attractive time to be at alts, right? When we think about our franchise, we're also looking at expanding. We have expanded our capabilities in private debt, and as the markets know, we have announced our partnership with Deutsche Bank in terms of the private credit. This is going to provide investors and us with unique opportunities that will be originated by Deutsche Bank.
All right, Hepsen Uzcan is America's CEO at DWS Group. A pleasure speaking with you today.
Thank you very much for having me.
Coming up, we're going to continue the conversation and focus in on trade with Marissa Adams, Regional Head of Global Trade Solutions for the Americas at HSBC. This is The Close. Commerce Secretary Howard Lutnick telling reporters that trade talks with China, quote, went really, really well. And he is hopeful that talks may end this evening, but could stretch into tomorrow if necessary. For more on how companies are dealing with the uncertainty around trade, let's bring in now Marissa Adams. She is Regional Head of Global Trade Solutions for the Americas at HSBC. And Marissa, we've seen markets react in a pretty volatile way, certainly through most of April, to all this trade uncertainty. Compare and contrast that to what you describe as corporate's response, which you call fairly measured.
Thanks, Scarlett, for having me again. And completely agree. It's been really interesting. I've been on the road speaking to customers and clients, both across the U.S. and Europe over the past few weeks. And what I would say is, regardless of industry, corporates are taking a watch and wait approach. They are pausing some investments, and we actually did a survey a couple of weeks ago, the HSBC Trade Pulse survey, 5,700 clients globally, 1,000 here in the U.S., and over 70% of them said they're pausing or reconsidering long-term investments. So that's the one thing that we're seeing, that if this trade situation continues, we are more concerned about.
So the president seems to favor these 90-day pauses. In what specific industries is 90 days a long time, just enough time, or not enough time?
Yeah, and it's really interesting depending on the order cycle. So if you look at consumer retail, where we'll see tomorrow what the CPI data shows, those are short order cycles. So in that sense, what we can actually see is that companies are seeing price increases already coming through. Versus if you look at oil and gas, longer term infrastructure, they haven't seen that come through. What I would say, though, is that over 77% of companies that we've spoken to, particularly in our survey, expect costs to continue to increase. So not only that 10% baseline tariff, and obviously you've got different tariffs when it comes to steel and other products, but they expect them to continue to rise over the coming months.
How much confidence are they going to have, though? Even if we do strike deals, there's been this sort of, at least in financial markets, obviously this sort of jitteriness, if you will, for lack of a better phrase, that anything could change, right? You can strike a deal and maybe a year later, maybe the president wants to renegotiate that. So how much stock can you put into whatever these numbers look like when we finally do see them on paper?
Yeah, and what we're seeing actually with companies, though, is that they are trying to control what they can control. So they can't control what the policy changes are every day. And I think, it's not just what's happening in tariffs in the U.S. You have a lot of geopolitical conflicts in other countries around the world. So what they are looking to control is really three things. One, on the supply side, how can they look at creating supply chain resiliency? Two, and this is actually new compared to sort of the COVID era, how do they find new demand markets? So what are new corridors? The U.S. consumer obviously remains the biggest consumer market in the world. And actually, we're seeing some of the U.S. corporates actually double down on the U.S. market, both from a supply chain perspective, but also demand.
Well, I mean, where are they looking, though? Because, I mean, we went through a trade war before in the first Trump administration, and a lot of companies sort of changed their supply chains. You had COVID, which also was a contributor to them sort of looking to diversify their supply chains. And then, of course, they woke up in 2025 and realized that it's not just China that's in the crosshairs, it's Vietnam, it's Bangladesh, it's Mexico, it's Canada. Where do you go?
So it's interesting industry by industry. So what we've seen, and if I talk about healthcare as an example, so even pre-COVID, they actually tried to do region for region. So it's kind of instead of trying to switch exactly where your supply chain is, bringing supply closer to demand. Now that's not country by country, so you can still be hit by some of the tariffs. The other interesting thing, though, and I always like to bring this up, is that 25% of trade is actually services trade globally, and largely untouched by tariffs at the moment. And actually even traditional companies, that whether they're in traditional manufacturing or in oil and gas, they are moving towards services models, because that's an area where we see world trade increasing by about 5 times goods trade.
And they're insulated from all these tariffs, at least in a direct way. Within the C-suite, which part of the business is leading the effort to respond to all this? Obviously the CEO, but he or she is relying on, someone with expertise in dealing with all this. Is it the purchasing manager? Is it the CFO? What are you seeing?
Yeah, it's a really great question. And why I say that is that what we're seeing right now is you've kind of got this great triangle of the CFO, procurement, and sales. And actually they're coming together to form sort of teams and different response teams around it. What I would say on that is that what's becoming a real focus for them too is working capital. So if we see a quick resolution, and I think now we're 8-9 weeks after Liberation Day, quick resolution is becoming a less and less probability. But in the prolonged area of a protracted area of uncertainty, working capital becomes key. So they're actually working together to go, how do I bring procurement, sales, and working capital together to go, gee, if I have prolonged uncertainty, I might actually need more cash. I might need to hold more inventory. So it's more of these squads that they're forming together. But certainly, I would say even more than COVID, this is a C-suite discussion. Absolutely.
All right, Marissa, great to catch up with you. Marissa Adams is Regional Head of Global Trade Solutions for the Americas at HSBC. And this is obviously a big topic of conversation, not only, of course, among what's going on with the companies themselves, but investors, too, looking for maybe some idea of what that navigation is going to look like.
Yeah, although, I mean, as we were just talking about, anything can change, so you kind of have to move forward with what you know, which is, the facts on the ground at the moment. The
facts on the ground, and of course, a lot of companies are being proactive in that space, particularly when it comes to insurance. Believe it or not, a lot of companies are taking out insurance policies and looking for guidance of how to navigate the trade environment. We're going to catch up with the CFO of Aon, Edmund Reese, fresh off his Investor Day. He's got a lot of thoughts on this. That's coming up next here on The Close. This is Bloomberg. All right, even insurers are having to deal with the weight of tariffs. Aon saying at its Investor Day yesterday that it's starting to broker insurance policies based on potential tariff impact. We're also, of course, officially in hurricane season, which could mean a potential windfall for insurers as well. Let's bring in the CFO of Aon, Edmund Reese, who joins us here live in Studio 2. And Edmund, I do want to start off with trade, because I mean, everybody right now, every company out there is looking for advice and looking for guidance as to how you navigate this. When they come knocking on your door, what exactly are they asking?
Romaine, we had, I think, 9 days after the global tariffs were announced, we had a call for risk managers to join. We were worried about was anybody going to show up. We had 4,000 risk managers show up because they were asking about, how do I change my supply chain? How do I handle the operations and resiliency of my teams in here? This trade is one of the 4 megatrends that I was talking to you about when you last had me on the show, in addition to climate and some other items. But it is clearly a boardroom topic that the CFO, the CEO, and the board are all talking about right now, and we are giving them insight on how they manage.
But how do you? I mean, what is that insight? Because we talk about this idea of how things are changing so fast. And, you know, a 10% tariff today could be 25% tomorrow, and then back to 10%, 2 weeks later. So what is the advice you give them? Is it to do something, or is it to stand still, or what?
What we've been doing, and the reason why we just had our investor day yesterday, was to talk about the insights and the capabilities that we have that can help clients with these. What we're doing is helping them understand what their exposure is. If their operations are impacted in country A or country B, how does that impact their growth and the objectives that they have? So what's the exposure? What's the volatility that would come with different tariffs in the different locations? How much of that risk do they want to have, or how much of that they want to transfer to insurers or other capital providers for that risk? So that's what they're asking us about. Like, if this impacts our business, what is the P&L impact, the cash flow impact, and what do we want to have on our balance sheet versus what we want to give to other insurers?
How many scenarios do you end up sketching out for them? I mean, it's multiple scenarios.
The beauty about our scenarios is it isn't an Excel spreadsheet with A, B, and C scenario. It is live demonstration of here are where your assets are. Remember, we have 4 different solution lines with tons of data. We're a market leader in insurance brokerage. We know where catastrophes are happening. We know where the properties are. We can help you with your supply chain. So they're seeing real life where their locations and where their business operations are. We're showing them if trades are impacting those areas, then what the impact could be to them and what they might want to retain versus transfer to other companies.
Romaine mentioned that we're also officially in hurricane season. We heard the president say today that his team will move forward with winding down FEMA, the Federal Emergency Management Agency, once hurricane season is over. How do you think about what that translates into for your clients? Our clients
are, Romaine, that was the topic the last time I was here. First, it was the California wildfires, unfortunately. Now we're going into hurricane season. These are increased risks that are creating more complexity for our clients. And if you're winding down FEMA, how are you supporting corporations who need to support their workforce and keep their operations going? We're coming up with solutions. Clients are asking for more of our advice. We're coming up with solutions that help bring other capital into the markets and help them deal with the complexities of maybe not having all of the historical, traditional support that they've had previously.
Well, what I love about your company is because you guys really do have just insights that a lot of other folks aren't going to have. And on that front, technology has become a big issue. A little bit earlier, we were talking about there was a hack of a company, United Natural Foods, and it's kind of affecting Whole Foods and some of its customers. And we're seeing more of these hacks. We're seeing technology become much more of a threat to what companies are doing. At the same time, of course, it's also potentially a benefit, as we know with AI, but with that benefit comes a certain potential threat, or risk, I guess, to put it in your parlance here. And I'm curious, is that even manageable?
Absolutely manageable. And by the way, just remember, when I was last here, I said there were 4 megatrends. We talked about weather. We talked about workforce. We talked about trade, which we just hit, and technology. In that technology, I called out companies being hacked, cyber attacks, particularly as there's more data with AI. That creates an even bigger risk. The key thing is right now, how much of that risk is being covered, how much is being insured. We estimate $15 to $20 billion. But the exposure is even much larger. That's probably covering about 12% of the overall exposure at the low end. So there's an opportunity for clients to assess how these risks are emerging. We, again, have data that we think and insights that can help them assess what this overall
risk is. Do you ever
risk
find, though, clients some of them just want to throw in the towel? Because I feel like if you were to make a board of all the risk out there, compared to 20 years ago, certainly 30, 40 years ago, it's got to be just infinitely more, right?
Well, it's not so, to me, it's partially because there's more risk, but now more connected risk. Climate is not just impacting your operations, but impacting your workforce as well. And by the way, sitting in the CFO seat, the risk managers previously reported to me. And I remember 10 years ago, I was interested in what the premium was and just getting D&O right for our board and getting, now to see that there's an impact on the workforce in addition to our operations that can drive volatility in our P&L or our cash flow, my risk manager has full ears, my full attention. So they're not throwing in a towel. We're looking for companies that have the solutions and data and insights that can help us manage the thing that I keep coming back to. The last point I'll make on it, remember, the reason why this industry is so attractive, part of it is it's required. You got to have insurance on your property. So it's non-recurring, non-discretionary business. But now you got this added impact of volatility. And that's the last thing you want when you're sitting in my seat. You want surety on your earnings and then on your cash flow.
You'll be waiting for a while then. As head risk manager in many ways, how are you thinking about the immigration raids that we're seeing, for instance, in Los Angeles and the threat of a military response? Already in LA, we've seen the deployment of 700 troops, to parts of the city. These are going to be companies that are affected, that are seeing their property affected, that can't send their workforce into the office because of this. How do you prepare your clients for that?
That's the key. I mean, you partially gave the answer in your question there. Our first focus is to make sure that our associates or our colleagues are protected in that market, because we're a global company in 120 countries, so ensuring that our colleagues are taken care of, but then helping our corporations who are doing exactly what you're saying. How's it disrupting their business? How's it impacting their workflow? So they want solutions for that. Business resiliency is something that we're planning for on an ongoing basis, whether it's driven by climate, whether it's driven by what's happening in California right now. So that's ongoing planning. It is not just having insurance coverage, it's embedding it in your ongoing planning. That's why it's a board topic these days. And that's why it's an incredibly exciting time to be in this industry.
Yeah, not just the CFO, really overseeing everything in many ways. And CFO Edmund Reese, thank you so much for joining us today.
Thank you.
Chief Future Officer, yes. By the way, that is a show that airs on Bloomberg Television. Romaine has spoken to plenty of CFOs, as have I, on that. All right, let's take a look at how the markets closed on the day. It was a melt up here in equities, with the S&P 500 still holding above that 6,000 level, but also still about 2% shy of that record high.
Yeah, I mean, this is kind of one of those where you climb the wall of worry, pick your euphemism there, and the big question is what gets us back to 61.44? Is it the economic data tomorrow? More importantly, is it the economic data going forward?
Or some breakthrough announcement.
Or breakthrough announcement, as we are waiting to hear the outcome of some of the trade talks that have been going on.
Yeah, look at the VIX, by the way, below 17, well below the average of 32 in April and 21 for the year. So that volatility has really calmed down here. Nothing happening in treasuries, and the dollar continues to kind of hold near two-year lows.
All right, we'll be back in a moment. This is The Close on Bloomberg. A second day of trade talks wrapping up between the U.S. and China. Scott Bessent, the U.S. Treasury Secretary, speaking in London.
My colleagues, Secretary Lutnick and Ambassador Greer, are going to be continuing as needed with the Chinese delegation. So thank you very much.
We're going to have a deal tonight.
Thank you very much, everyone.
When it comes to export control, sir, what's being discussed?
What were you able to offer the Chinese, sir?
What do you think about Fed Chairman?
Romaine, if you still have me, we just heard from Secretary Scott Bessent coming out of the negotiations. He said that his colleagues, Ambassador Jamieson Greer from USTR, as well as Commerce Secretary Howard Lutnick, are going to stay put here in London and continue the trade negotiations. The Treasury Secretary says he is heading back to Washington, D.C., because, as we've been noting, he is testifying tomorrow before the House Ways and Means Committee. At the moment, the trade talks are still ongoing. This is the second day, and in total, they have been talking for about 13 hours here in the city of London. Remember, just a month ago, they met in Geneva. Both sides said they reneged on what they agreed upon in Geneva, and that is how we ended up here today in London.
What they are talking about? What are the main sticking points? Has that been articulated at all by Bessent or any of the other folks in that room?
What we've been hearing and really what's been signaled as well by the administration are two key sticking points, really the choke points for both Washington and Beijing. When it comes to Washington, they want to see an advanced pace of the rare earth minerals and the magnets. China has more than 70% of control on this market. And when it comes to China, they want to see more access to semiconductors. Since the Geneva talks, we have seen the U.S. put in place more export controls on things like jet engine parts, some nuclear materials. They want to see that lifted. And then, of course, there's this red line where Kevin Hassett, the NEC director, said earlier this week that they would not be willing to give into things like the NVIDIA H20 chips that NVIDIA made to be export compliant under the Biden administration so they can still export to China. But you have to wonder, these talks are taking so long. Potentially, is that a red line and a sticking point that they are still discussing here today? These are just two of the policy issues that are being discussed, part of a broader deal. We have to remind ourselves, we are only really a month into this when you consider the first sit down when it comes to Geneva. In the first Trump administration, the trade war started in 2018 and it didn't end until 2020. And that was just a purchasing agreement. When it comes to this trade negotiation, we are talking about a whole host of issues. A plethora of issues between these two countries are on the menu, and it is going to take a lot more time.
All right, Bloomberg's Amory Horder, thank you so much joining us from London. And of course, Scott Bessent, the Treasury Secretary, did come out and say that the discussions between Chinese and U.S. officials will continue tomorrow, a third day, with Howard Lutnick, the Commerce Secretary, and Jameson Green, their U.S. Trade Representative, staying on in London to hold those discussions while he, Scott Bessent, will be returning to Washington to testify before Congress. Let's switch gears here because we're going to take a look at Fortress's real estate conference, which is kicking off in Los Angeles here in the U.S. And Lisa Bromwitz, the co-host of Bloomberg Surveillance, is there now with Fortress Investment Management's co-CEO, Josh Pack, as well as the vice chairman, Tim Sloan. Lisa, I'll hand it over to you.
Scarlett, thank you so much. It's sort of like one pole of the story that's been dominating news to the other here in Los Angeles. We are in Beverly Hills, and I am here, I'm so glad to say, with Josh Pack as well as Tim Sloan. You both hold a whole host of different titles, one of them being the co-heads of real estate. And I want to start with the fact that we are in Los Angeles. And there has been a lot of discussion about the protests and some of the military presence. And there's a real question as investors how much some of these types of political backdrops and social backdrops affect where you invest. And Tim, I'm curious to what degree it really is affecting the flow of investment.
I think the primary driver, if you just want to look at Los Angeles, of investment here is, where the economies are very active, right? And so what you're seeing in LA is downtown LA, where some of the protests are. That office market is under a tremendous amount of strain. You're seeing buildings that are now selling for less than they were sold for in 2014. You go 10 miles to the west where we are, or maybe just to south where we are in Century City and Culver City, and you're seeing new offices being built because that's where the demand is. So I would say it's much more a function of the economy than it is political events.
Yeah, and I'd say, why there are these kind of things going on, it's not like the war zone that people make it out to be. LA is a big place. There's some issues that are, currently happening that tend to be pretty localized.
Yeah, well, there is this question on a broader level, just how much the political backdrop has changed, not only where you want to invest, but also where your investors want to invest, and whether over the past 6 months or even 6 weeks, you feel like some of your investors have been shifting gears about where they want to be invested. Is it still the United States? Is it more outside of the United States?
I think across the board, there's significant demand for investment here in the U.S. There's a large trend towards kind of private credit taking market share away from the commercial banking system. And we've seen that in a number of different products, whether that's real estate, private credit, forward flows, consumer finance. And it's we think it's a terrific opportunity. We think it's kind of a long-lived opportunity and one that we're going to be investing in for, a significant period of time. And at the same time, we're seeing lots of opportunity in Europe. We're seeing, great continuation of investing of our Japan franchise. So, we're pretty active all over the world now.
Yeah. Lisa, at the end of the day, investors go to where they're going to get the best returns. And there are still incredible opportunities here in the U.S., but also in the other markets that Lisa mentioned, or that Josh mentioned.
When you talk about the United States, are you talking residential, are you talking commercial? Is there, within the residential market, more room for some of these private asset managers at a time where there's an increasingly stagnant market in some ways because of mortgage rates?
Oh, I think there's a lot of opportunity in the residential market. It's actually, for example, we're one of the largest purchasers of tax liens in the U.S. And those are very, very attractive risk-adjusted returns. You're generally buying those at about a 10% yield for being less than 1% loan to value. We're interested in buying mortgage servicing rights, particularly those mortgage servicing rights where the coupons are below 4%, which are unlikely to be refinanced for a long time. So there's opportunity everywhere in residential.
And on the commercial side, try and get a construction loan that, today from your bank. It's very, very hard. We're filling that gap. Not only are we filling it through our own lending products, but other parts of our business. For example, our net lease business does a lot of build-to-suit now. We're probably doing more build-to-suit product, particularly in things like technology, data centers, things of that nature, than we have ever done in the past, because it's hard for these developers to get financing on a construction basis.
Tim, you used to be CEO of Wells Fargo.
Yep.
It strikes me that a lot of what you're talking about that you're doing right now is somewhat similar.
Very similar.
To what you were doing there.
Very similar.
How is it different, and how much do you see it actually taking over a lot of the roles that you used to have?
I think Josh mentioned the disintermediation of the banks with private credit. We saw that in corporate credit over the last 10 years. We've created a $1.7 trillion industry. We think that's going to happen in commercial and residential real estate. It's happening right now in the growth of our business. And all that's happening is that the riskier part of the lending book that banks have historically done is moving to private credit. The good news is the banks are providing us with our financing to be able to make those loans. Because when you look at the largest category of loans that are growing on the balance sheets of the largest banks in this country, it's loans to non-depository financial institutions. That's 12% of the banking sector today.
So, Josh, I'm curious where we are in that cycle of the disintermediation, given the fact that that was the story for the past number of years. And then now there's this real focus on deregulating the banking sector, which would allow them potentially, unshackle them to go back into these businesses. I mean, at a certain point, is there going to be that kind of competition?
I mean, there could be. I mean, this is, I think what you're seeing with private credit is absolutely here to stay. The private credit market itself is going to be a $6 trillion market in 5 years. I mean, you're not only seeing us disintermediate banks, but other types of financing in the market. Things have been moving away from CLO financing, for example, into private credit. So those are all trends that we think are going to continue. And now with kind of real estate emerging as this large private asset as well, we think there's great opportunity there.
You keep using the word opportunity. It doesn't mean that things are going to be going swimmingly necessarily in terms of prices going up or valuations going up. I am curious where you think we are with respect to that, given the fact that rates are high. The volume of sales has fallen off a cliff to the lowest levels that we've seen in more than a decade. And there's this feeling of stagnation. Do you have a sense of where we are?
Well, I'd say, Tim and I have both been through our share of financial crises and restructurings. And the past couple that we've had, whether it's the pandemic or the global financial crisis, those were kind of unusual crises at the end of the day because the central banks came to the rescue and they flooded the world with liquidity. Asset prices were buoyed up. What we have today, I think, is a more normal type of recapitalization or restructuring of the banking system, of the real estate markets, and that takes time. That's going to take 3, 4, 5 years to ultimately get from point A to point B.
This cycle was primarily driven by rates. Your point about rates growing up. Now, I remember when I got my first mortgage and it was 13%, and it wasn't the end of the world.
Prices were a lot lower then. So it's a very different market, but carry on.
My salary wasn't at the time, but that's another topic. But I think the point that we're making is that we think that this cycle is going to be elongated because it wasn't necessarily driven by overbuilding. Right? It's not being driven by a pandemic. It's not being driven by a decline from a recessionary environment. It's really driven by rates. And so what we're seeing is that the banks slowly but surely are moving back from providing commercial real estate loans. We're stepping in, and they're slowly but surely working off the portion of their portfolio that's really not performing as well.
We say the banks are amortizing their problems away, and that's going to take time because they're not re-injecting that capital out into the markets. They're using it to build up their reserves, to get in a position to sell assets, hopefully to us eventually at distressed levels, which we like doing as well. But
how many trillions of dollars of assets do you estimate are going to be moving from the banks to the private market?
I don't know for sure, but I think one of the statistics that we look at in the commercial real estate world is over the next 4 years, there's $4.5 trillion of loans that are going to maturing, and they've got to find a home, right? So could it be $1 trillion? Could it be $2 trillion? Absolutely.
There's a question on a larger basis, and we've been talking to a lot of investors about this. We talked a little bit about how you're expanding in Europe and you're expanding overseas. Josh, congratulations. You're moving from Dallas to London, I believe. What's behind that? I mean, do you see that as sort of a more ripe opportunity for investment right now than even the United States?
Well, there's a bunch of reasons. The investment piece is certainly an important one. We think there's great opportunity not only in our real estate franchise over there, but also in our private credit business. We have been expanding and pushing hard into private credit and lending. But we also think that we can look at the fundraising side of it as well. Not only our institutional capital, but private wealth is a growing sector of our business like everybody else's, and something that we have kind of zero presence in Europe currently.
Well, I guess that to ask that in a more pointed way, and I'll ask this of you, Tim. At a certain point, has some of the policy uncertainty caused a greater degree of reluctance to make long-term commitments in the United States in certain areas because that adds a certain risk premium that maybe you're not getting compensated for? Do you see that on a global scale?
Absolutely not.
Okay, so that's not the case.
Nope.
Where is your fastest expanding place? I'll leave with that.
From a
Yeah, in terms of Fortress's presence geographically, where are you expanding?
I mean, we're going everywhere. We just opened an office in Abu Dhabi. Our office in London is going to be doubling, almost tripling in size over the next few years. So there's a ton of activity in Dallas. We're 150 people now. We think we're going to be 200. By the end of next year, the year after. So we think there's an incredible amount of opportunity for us, particularly as the markets kind of stay, unsteady to a certain extent, and we can deploy capital in really interesting ways.
Josh, Tim, thank you both so much. Really appreciate your time. Scarlett, Romaine, I will send it back to you in New York.
All right, our thanks there to Lisa Abramowitz out there at the Fortress Investment Management Conference there with Josh Pack as well as Tim Sloan. And we'll be hearing more from her, I believe, tomorrow. Meanwhile, we want to set you up for what the market's going to have their eye on over the next 24 hours. And we should just really point out straight off the top here, we are expecting those trade talks with China to resume. Scott Bessent does have to come back to the U.S. for a previously scheduled engagement, but Howard Lutnick and Jermaine Greer, the U.S. Trade Representative, are staying behind.
They're staying behind, and they said they'll stay for as long as needed. So right now we're counting into our third day of trade talks. Scott Bessent, as you mentioned, has a full day of testimony on Capitol Hill. So we'll be, of course, bringing you up to date on those headlines.
Meanwhile, we will keep an eye on earnings. We are going to get chewy before the market, so a bit of a read potentially on consumer spending. But
this should not be discretionary, by the way. This should be a consumer staple.
You speak on behalf of all the dogs and cats out there, Scarlett. But of course, 8:30 a.m. Washington time, that is going to be the big data point of the day, the consumer price index.
Yeah, and of course, that's the big one. Right right now, we're looking for an increase of 0.2% month over month, year over year, 2.4%, slightly higher when you back out food and energy prices.
And it'll be interesting, too, because a lot of people are expecting not the spike in inflation this time, but maybe the next report or the report after that, PPI tomorrow. We get the federal budget balance, at 2 p.m. Eastern time, and we get Oracle earnings after the bell.
Yeah, and it'll all be about the cloud and, of course, the implementation of AI.
AI. This is the close on Bloomberg.